You trimmed Apple and Microsoft.
We did. We did.
Why did you do that?
Well, you know, it's not because I dislike technology. We've talked about this on the show many times, and have a very strong view about technology and the importance of innovation. But what we have been doing over the last 18 months is really thinking about how we're accessing technology and where we're taking those positions. So if we go back in 18 months ago, we would have had overweight to the market positions in both Apple and Microsoft.
Right.
We've trimmed those back in order to continue to fund other names. Now, those two specifically are for two separate reasons. Number one, we do believe that there is going to be some continued pressure in this near-term period as we think about rates and we think about what could potentially happen with the Fed's dot plot in March.
Okay.
And so we think that those larger names may continue to see some pressure. And the other reason is that if you look at what's happening with the consumer with Apple, if you look at what's happening with some continued concerns about China, for Apple specifically, that's our largest holding still, but we certainly don't want to be above benchmark weight in that, given some of the near-term concerns we have.
Okay, so today Morgan Stanley bumps the price target, Eric Woodring over there, to 180. He thinks there could be an extra $1 trillion in market cap unlocked from AI. And Apple today, by the way, some are making the case, I've gotten emails already, you know, so goes Apple, so goes the market, right? Dow's up 250 now. Apple's pushing back towards 150, making another nice move here. And by the way, there's a Dow Jones headline today, too. Foxconn is set to expand iPhone production, and they're going to have an expansion in India. I just wonder if now is the wrong time to, you know, get off this train, so to speak, that, you know, people are still going to put money where you go where the money is, and the money is still going to flow to Apple.
Well, in our growth portfolio, this still represents almost a 5% position. So, I mean, this is not a small position for us. It's just relative to the weight in the S&P 500 and thinking about the potential for other parts of either the tech sector or other sectors like industrials and healthcare to potentially lead into the second half of the year. Now, that's not to say that I couldn't see a scenario where we would potentially add to those positions again.
Okay.
We do think that they deserve probably at least a market, if not market overweight, in a 2024 scenario where we're in a lower rate environment. But for me, I'd rather go into names that have a stronger competitive advantage or potentially a better valuation. One or both of those that I think might make sense in this interim period.
So, okay, so you trim Apple, you trim Microsoft, you bought into it. But I mean, that's not exact. You think that's cheap?
No, I don't. That's why I said competitive advantage and or valuation,
okay,
Scott.
The and or
so, you know,
was the underline, because I'm looking at the PE and I'm like, what?
Well, because we've added to we've added to Cisco this year, we've added IBM this year, or in 2022. Intuit has a competitive advantage in terms of the type of business that they are operating in, which is tax and accounting, which tend to be much more resilient, not fully insulated from recession, but much more resilient than some of the enterprise spending that you have consistently raised awareness of, for me, about on the show in terms of what if enterprise spending slows? Agreed. I love the move to the AI platform that Intuit is focused on. I like the business that they're in and the fact that they're getting better margins off of their online, which is now a majority of their revenues, leads me to believe that we continue to have margin expansion for a company like this, where margins are potentially under fire in other parts of the sector.
Weiss, let's kick this around. Trimming some mega caps, going to other areas of growth where you think you have some advantages that maybe you don't have now in other places.
Yeah, as far as Apple, it's an interesting point because Foxconn is increasing, and Apple's trying to increase their supply chain outside of China, and I think that is a real risk. Apple's largest employer in China through Foxconn.
Risk is the China risk, not So
20% of what? I think it's 20% of sales come from China.
Right. So there's a risk there. Look, I don't think there's anything wrong with owning Apple here, but to think that they'll be immune from what we're seeing with the consumer generally, I think is misplaced. So it's going to hit them on their phones. However, you still got the phone companies subsidizing them, so that gets in the way of that headwind. In Microsoft, I still believe you can get it cheaper. I don't think it's compelling here. So I'd love to own it. I think I'll own it at lower prices. That's been my strategy, and I will own it. What we're seeing in the move today in the markets goes back to what I've talked about repeatedly. You're in a data-free window right now. We know what the Fed speakers are going to say. Okay, we know next week you've got employment at the end of the week.
I mean, you had services PMI today, right? That was good.
It was good. It was above. It was good for if you're
above expectations.
Yeah, it was good, but it didn't blow away, and the market sort of said, okay, we know the data's good, we know the economics are good, but until we get a hard, real important number like CPI or PPI or the jobs number, then we're not going to.
I hear you, but this move, into the close yesterday when I was doing closing bell, and then today. It's pretty resilient market. I mean, if you had the 10-year was at 407 yesterday.